So FICO stock has been an incredible compounder over the last 5 years, up 317%. The S&P in that time frame has been up a little over 100%, so it's up 3 times the S&P 500. However, you can see here on the chart, in the last year or so, there's been some turbulence in the stock. Specifically, when you look on a year-to-date basis, you can see that it's down 2.1% on the year. And more recently, it had a pretty steep drop from over $2,200 a share all the way down to $1,500 a share. It's recovered some, but not enough. So this could represent an opportunity for us to acquire a stock that has been a significant compounder over the last 5 years. And so to do that, like we always do on this channel, we're going to use ChatGPT to analyze the stock. Should we buy, hold, or sell? We're going to look at it from a fundamental perspective. What's driven the stock down more recently? Are the issues that it faces more permanent or short term? Can it recover? What should our strategy be here with this particular stock? All right, let's dive in. So first, let's dive into what the company does. To get that, I use a prompt asking ChatGPT to tell me exactly what the company sells, who it buys from, why do its customers buy, when do they buy, and what problems it solves for them. So here you can see it says FICO is a data analytics company, and it has 3 key offerings. So FICO scores, which you and I are familiar with. For most of us, it's either a point of pride or a point of shame, depending on what your FICO score is, because it plays a role in almost every financial decision that you make, making the products and things you buy either more expensive or cheaper, depending on how good your FICO score is. So we're all familiar with it. It's utilized by over 90% of US lenders, and the lenders use it to determine consumer credit risk. So how risky a borrower are you? It also has its cloud platform, which helps its customers leverage AI to automate their business decisions when it comes to evaluating credit risks. And then finally, it's got fraud detection solutions as well. Now let's talk about the recent developments that have driven the stock down. So the director of the Federal Housing Finance Agency, Bill Pulte, criticized the company, specifically the 2024 decision to raise its royalty fees from $3.50 to $4.95. That's about a 50% increase in price, which obviously, now, as a holder of the stock, the fact that a company can increase its prices 50% can be a really positive thing, especially when it doesn't have to increase its costs accordingly. Now, from the perspective of the government, raising its prices by 50% is a problem because it raises fees on consumers. At least that's the argument of the director of the Federal Housing Finance Agency. Now, that criticism led to the stock dropping by 30% in a 5-day period. So when we go back to the chart and we look at the stock drop here around May 19th through May 27th, that's the continued stock reaction to the comments by the director of the Federal Housing Finance Agency about the price increases that FICO imposed. In addition to the pricing increase that drove the scrutiny by the FHFA, FICO also has a significant part of its business model under scrutiny as well. And that part of its business model is the piece that combines all 3 credit reports and provides that to its customers for the evaluation of consumer credit risk. And the FHFA is proposing transitioning from a tri-merge to a bi-merge system, meaning that maybe you don't need to see all 3 credit reports in order to determine the credit risk of the customer. The impact on FICO's revenue could be significant as a result of that. And that's why we saw the stock decline that we did. So let's dig into its business model to figure out exactly where its revenue could be impacted if the FHFA went through with imposing some sort of pricing caps or transitioning from the tri-merge to the bi-merge systems for consumer credit risk evaluation. So FICO operates in 2 major business segments, and that's its score segment. And in 2024, the score segment made up 60% of its revenue, or roughly $1.2 billion, and the software segment made up 40% of its revenue. So the piece of its business that would most likely be impacted is its score segment. So looking at its score segment means 60% of its revenue, we want to understand what the margin impact could be if some sort of cap is imposed on that segment. And so ChatGPT helps us understand that even though the score segment makes up 60% of its total revenue, it makes up about 75% of its operating profit. So the contribution margin from its score segment is significant to its overall operating profit. And so it's not a 1-for-1 reduction. So for every % reduction in revenue in that segment, you lose about 1.25% in operating margin. That's significant. So ChatGPT runs us through a few scenarios. In a base case, everything stays the same. There's no impact. No price caps imposed by the government. No changes to the tri-merge system of evaluating all 3 credit reports. If there's moderate impact, so there's a partial adoption of the bi-merge system, meaning just using 2 of your credit reports versus 3, you can see a 10 to 15% decrease in the score segment revenue. In the case of severe impact, a full transition to the bi-merge system could result in a 25 to 30% decrease in the score segment revenue. So at 30% of 60, we're looking at roughly a 20% reduction in overall revenue for the company, FICO, which would result in a roughly 25% reduction in its operating profit. That's in a worst case scenario based on this really simple scenario analysis that we've done here with ChatGPT. So some things the company has going for it is that it does have the software segment, which is 40% of its revenue, and that will continue to exist and support a significant portion of the business. And like any good company, they are engaging with the government to ensure that the impact on their company isn't the worst case scenario. So what we're really looking at is an impact somewhere in between 0 and probably 30% of its score segment revenue could be impacted. So how likely is this to really impact the company's long-term viability? And to do that, one of the questions I asked ChatGPT is to evaluate the moat of the business. And so to evaluate the moat, we look at 5 key areas. So we look at what kind of intangible assets that the business has, switching costs, how much would it cost for a customer to walk out and leave and use someone else, the network effect that the business has, its cost advantage, and efficient scale. So can it continue to scale with minimal increases in its overall costs? And from an intangible asset perspective, FICO's brand is synonymous with the evaluation of consumer credit risk. Not only are consumers very familiar with the product, 90% of lenders use FICO to evaluate credit risk. And you can imagine that them trying to change that overall process will take a significant amount of time for them to walk away from the tri-merge system, which is what they use now to evaluate credit risk. No bank wants to lose money. And the easiest way to lose money is to change your systems abruptly to something different that is not as tested or tried and true as the system that you've used for decades. So that represents a very significant piece of FICO's moat. Switching costs. Similarly, the company's got very deep integration into lender systems. So you can imagine having to retrain your systems to use a different system to evaluate credit risk. Network effect. So lenders know FICO, consumers know FICO. It's a very symbiotic relationship. And finally, efficient scale. So I have to imagine that running a FICO score report is a very cheap thing to do. Yet the company is charging somewhere between $4 and $5 for each FICO score that's obtained. What that tells me is that the incremental costs to run an additional report isn't that significant compared to the price that's charged. And so we get a total moat score of 18 out of 25, which is pretty good. So let's check out the company's performance over the last 5 years. And you can see that it's been a dominant performer. The revenue growth hasn't been that significant, going from 2% revenue growth in 2021 to 14% in 2024. But check out the profitability growth. It's net income growth. So every additional dollar in revenue that the company gets, it's converting at a 2 to 4x level to net income, which is just simply amazing. You can see how it's improved its profit margin significantly from 2020 at 35% to 2024 at 49%. And you can see a similar free cash flow growth in the business as well. This goes back to the efficient scale point that we made, which is that every additional dollar in revenue does not incur significant additional incremental costs to deliver that revenue. And these are the best kinds of businesses to own. Now, from a price to earnings perspective, the company is expensive, trading at 74.4 times. So things need to continue to go perfect. And when you have threats like the ones that we have today from the government, you can understand why the stock would be down 30% in the space of 5 days. It's got almost 30% return on assets and 36% return on invested capital. Very strong financial valuation and profitability metrics, except that it's a little expensive from a price to earnings ratio perspective. So we need to watch that. Looking more deeply at its valuation metrics, you can see that it's trading pretty expensively compared to its 5-year average, its 10-year average, and its industry average. Similarly, its enterprise value to EBITDA is at a premium to its historical average. And so that's something to be watchful of. And again, when a stock is trading that expensively, any piece of news that could be perceived as negative could impact the stock pretty significantly, pretty quickly. Also, when you look at its competitors, so FICO trades at 73 times, Equifax at 53, Verisk at 45, MSCI at 38. Although I don't think MSCI is a direct competitor to FICO. Equifax is probably the most direct competitor to FICO out of these 4 names, and it's trading at a discount to FICO from a price to earnings perspective. Though from a price to earnings growth perspective, it's trading more expensive than FICO. Equifax could potentially be a beneficiary if the government does change the rules to become more of a bi-merge system versus a tri-merge system where you use all 3 credit reports. You can imagine each individual credit report becomes more important in a bi-merge system over a tri-merge system. So we asked ChatGPT, what's the sentiment around the stock currently? And if you look at some analysts that cover the stock, you can see that as of May 28th, which is after the comments by the director of the FHFA, these analysts reiterated their belief that the stock is a strong buy, overweight. Target price of 1900 of 2600. Barclays overweight at 2250, although that's before this regulatory concern came up. So the consensus is a moderate buy with 2304 as the price target as of May 30th. Most analysts are buy on the stock, 4 are hold, and 2 sell. Also, I asked ChatGPT, what does sentiment look like with retail investors like you or I? And so it goes and scans through Reddit, Twitter, and stock tweets. And you can see that there's mixed sentiment on Reddit and stock tweets, and a little bit more negative on Twitter, as Twitter is a news platform. So as the regulatory scrutiny dominated the news, it drove sentiment pretty negative for those periods of time. But again, that's just a signal. It doesn't necessarily mean that we invest or not invest, but it's just a data point for us to use in evaluating if we should buy, hold, or sell the stock. The next thing I really wanted to understand was, what are some of the additional risks that the company might be facing? And so we already talked about the regulatory risks associated with the company, but it also has some competitors that are on its heels. So one of the things that FICO doesn't do is that it does not evaluate other non-traditional scoring models, like looking at your payment history on your utility bills or rent or other key payments that could qualify you in a positive light to creditors. And so there are some competitors that are nipping at its heels to provide that solution. So that's something to be watchful of. But again, FICO does have the network effects down. And for its competitors to really gain market share here, they would have to unseat FICO as the core measuring process for 90% of lenders in the country. Also, the company's got some debt, about $1.5 billion worth of debt, but it's not due for another 8 years or so. So not that big a risk. So I asked ChatGPT to delve into the competitors so that we could really understand, okay, what are we dealing with here? So like I mentioned, other methods for evaluating credit risk is looking at how well you've paid your utility payments and your telecom payments, your phone. Are you paying your rent on time? What are your spending patterns? What is available in public records about you and your behaviors, court records, corporate registries, public databases, and then your social media and online behavior. So be careful what you post online, because this could be used as part of the evaluation of your credit worthiness to banks and other financial institutions. So there are several companies that are vying to be competitors to FICO. So you've got VantageScore. They incorporate trended data and alternative data like rent and utility payments. You've got Plaid, which a lot of small businesses use today. It's able to analyze bank transactions and data to assess your income. Scoreplex, big data scoring, Chime and Credit Sesame. So these are all things to just keep in mind, that there are competitors that start to nip at the heels of FICO, though they may not have gained enough traction yet to be significant competitors, but just something to keep in mind. In fact, one of FICO's competitors has been gaining some ground. So in 2024, VantageScore's credit score usage increased by 55% on a year-over-year basis, reaching a record 41.7 billion scores delivered, up from 26.9 billion delivered in 2023. There are currently 3,700 banks and fintechs that have adopted using VantageScore. So something to note is that many lenders are using both FICO and VantageScore credit scores, and that's been driven by regulatory changes and industry practices. So it's almost like you're allowing the fox into the hen house, and maybe at one point the fox is going to eat the hen. But at the same time, the fact that both scores are being used may represent the fact that FICO continues to maintain a significant dominant position in credit scoring for individuals. So the bull case on the stock is that it continues its market dominance and strong financial performance, and the analysts who have access to a ton of data are still very bullish on it. So that could give some confidence. The bear case, though, is that this scrutiny by the government is new, and we have a government that's really focused on a lot of consumer issues, and this could be a place where they decide to make an example of a company. And when you get in crosshairs of the government, it can be a difficult place to get out of. The other piece of the bear case is that the competition is increasing in the space, right? Now, the company does still have its dominant position, but with each passing year, the competition gets better and better. They start to build network effects of their own and become part of the overall stack, which could make FICO replaceable. So what do you think of this stock at this point? I think from my perspective, when I look at the price performance over the past 5 years, it's been strong. However, in the past year or so, it's since seen some significant volatility, and it continues to be an expensive stock, trading around 75 times earnings. This could be one of the ones where we stay away. This is a stock that I'm personally not buying at the moment because of the lack of clarity regarding the regulatory scrutiny. If the government imposes some sort of price caps on the company or transitions from a tri-merge to a bi-merge, system, those changes could significantly impact its revenue in its score segment. And at that point, the stock would have to re-rate and its valuation would be different from what it is today. So I'm going to be in wait and see mode on this one, although I might be quick to pull the trigger at certain price levels or as things becomes a little bit more clear. So what do you think about FICO stock? Is this one that you're going to be investing in or adding additional funds to? Let me know in the comments what you think. In the video right here, I talk about how to analyze stocks with ChatGPT. I walk you through each of the prompts that I use and how you can use it for your own stock evaluation to cut out a bunch of time from your stock evaluation process. If you enjoyed the video, please like and subscribe, and I'll see you in the next one.